Well, good morning, everyone. We still have some people joining, but we're gonna go ahead and get started right on time and get through some of the introductions. Uh, I appreciate everyone taking time out of their busy schedules to spend a little time talking about business valuation for a professional design firm, specifically entities operating in the architectural and engineering industry. There's a little bit about me. One of the questions that we get asked quite frequently is this being taped and will you get a copy? And the answer to both is yes. So certainly you'll be able to go back and listen to any of the information and reach out with questions if you have any. A little bit about Dannible and McKee. We are a full service CPA firm headquartered in Syracuse. We have offices in Binghamton, Schenectady, and Auburn, New York, as well as an office in Tampa, Florida. We provide the full range of assurance, accounting, tax, compliance, those types of functions, as well as forensic valuation and advisory services. Our industries include, in addition to the AE sector, automotive, construction, healthcare, manufacturing, not-for-profit, and retail and wholesale. And we work with AE firms across the country, not just in the central New York area. And the way we do that quite often is through our sister firm, Dannible McKee and Associates, which is a sister firm that was formed to work specifically with architects and engineers. And within that company, we assist entities with business valuation, as well as ownership transition consulting. And I teach, and some of my partners teach with me, a full day seminar that discusses successful ownership transition, valuing a business, some of the different mechanics and cash flow requirements of setting up a successful ownership transition plan. So that's something that you could certainly look into further by visiting us at dmconsulting.com. This gives a little overview of some of those types of services that I was discussing, business valuation being a big one as far as services that we offer. Do a lot of these for internal ownership transition, but we're seeing more and more in the area of mergers and acquisitions. We frequently are asked to value a business for estate gift tax purposes. Employee stock ownership plans, or ESOPs, is another reason that AE firms frequently need evaluation. And hopefully, if you were to attend our full day seminar and learn a little bit more about what should be included in a buy-sell agreement, hopefully you would not get to the last item there, shareholder disputes, because things would all be ironed out ahead of time. All the unforeseens would be addressed to the extent possible in a successful buy-sell agreement. So we do consulting in that area as well. I mentioned ownership transition, whether that's internal transition, stock redemptions, mergers and acquisitions, ESOPs, all of the like. And then the firm also does some very specialized consulting, whether that's benchmarking and financial ratio analysis, fire overhead audits and rate analysis, litigation support, employee benefit plans, and the like. Those are all things that Dannible McKee and Associates can assist an AE firm with. A little bit about myself. I'm a partner with Dannible and McKee. In addition to being a CPA, I'm also accredited in business valuation and a certified valuation analyst. I'm also a principal in Dannible McKee and Associates. You can read more about my background if you get bored at night later on this evening. At any rate, before we discuss valuing a business, one of the key components that we have to look at is the proper accounting basis and format of your financial statements. And this is something that I would go into much greater detail in the full day seminar. Would be walking through the ins and outs of accounting basis, the formatting and ratio analysis that can be done when your financial statements are in the proper format. But I want to give you just a real high level glimpse of what's required before we can start the valuation process. So the methods of accounting that are available to an AE firm include the cash basis method and the accrual basis method. On the cash basis, income is recognized when the cash is received and expenses are recognized when the cash is paid. The advantage of this is it's very popular with firms because of its simplicity, and because it's the method that is available to AE firms, and it should in all instances be the basis that is used for tax reporting purposes. If you're an AE firm and you are not on the cash method of accounting for tax purposes, I would highly encourage you to reach out to me, and I will put you in touch with one of my tax partners, and we'll get that straightened out. Because you definitely want to be not paying tax until the cash is received, which is what the cash basis method permits. The disadvantages are it's not in accordance with generally accepted accounting principles or GAAP. It also understates your net income in a growing firm because it's not recognizing that additional growth at the time that the services are being rendered. It's recognizing them as the cash is received. So there's a delay in recognizing that growth on your income statement. It also understates the net worth of the firm on the balance sheet because some of your most important assets, your accounts receivable and your unbilled work in process, are not reflected. Therefore, the equity is understated. And finally, it fails to match revenue with the costs incurred to generate that revenue. And by that, I mean that you're recognizing your revenue when you collect from the customer, from your client, and you're recognizing the expense when you cut the check. And there's an ability to delay, for example, paying your accounts payable, paying your sub-consultants, that may put the recognition of the revenue and the recognition of the cost in two different periods. So from that perspective, the cash method of accounting is less desirable for managing the firm for profitability. It's certainly a method that you should include in your repertoire of financial statements. It's something that you definitely want to look at so that you can manage your cash and manage your tax position. But what we'll see is that the accrual method of accounting does a better job of matching, for one thing, the revenue and expenses so that you can manage the profitability of your firm. Under the accrual method, revenue is recognized when it's earned and expenses are recognized when incurred. So as you are performing your services, you are recognizing the revenue through the generation of your accounts receivable by invoicing the clients, and your expenses are recognized irrespective of when they will be paid. So there's a really good matching that happens there. It also complies with GAAP. The disadvantages are that it's just not as simple as the cash method of accounting. But most softwares, if everything is properly mapped initially, it's very easy to generate both cash basis and accrual basis financial statements. So this is just reflecting what a typical balance sheet on the accrual basis might look for an architecture or engineering firm. And I've highlighted the accounts here that would not be reflected on a cash basis balance sheet. So as you can see, your accounts receivable, your unbilled work in process, and then any allowance for doubtful accounts that you might not collect on or might not bill out of your work in process. You'll also see prepaid expenses are something, it's an asset of the firm. So for example, when a firm prepays its malpractice liability insurance for an entire year, rather than that hitting as expense in 1 month, it should hit prepaid expenses and then be expensed pro rata over the course of the year. And that asset would be reflected on an accrual basis balance sheet. All of these assets would serve to increase the equity in the firm. On the liabilities side of the equation, you're going to have trade accounts payable, any accrued liabilities such as accrued vacation, for example. Those types of liabilities would all show up, and they would serve to reduce the net equity in the firm. And I don't have a slide for it here, but just to mention it quickly, when you think about what stockholders' equity is or net book value, I will use those two terms interchangeably. Think of that in terms of it's no different than your home. So the asset is your home. The liability is the mortgage, and the difference, hopefully the excess of the fair market value of the home over the mortgage is the equity in your home. It's the same principle for your firm. The assets less the liabilities that would have to be paid results in the net book value or the stockholders' equity of the firm. So just something to point out, because stockholders' equity is going to be a starting point for some of our valuation procedures. And then looking at this very quickly, I just wanted to point out that an income statement, in addition to being on the accrual basis, the formatting of your income statement is very important. We often see that firms that are using, let's say, a QuickBooks or another kind of over-the-counter software may not have their financial statements, and in particular their income statement, formatted properly, and instead it'll appear very similar to a manufacturing type entity where they have sales less cost of goods sold. Per se, you don't really have cost of goods sold. You do have consultants and reimbursables that are included in your gross revenue. Backing those off, you should be reflecting net service fee revenue as a standalone item that you can look to on your financial statements. That's the true measure of what your firm is producing, the services that your employees are providing. And that's going to be the key that we look at for a lot of ratios, and measuring other expenses will be to the net revenue, not the gross revenue. From that, you would subtract direct labor, and that's going to give you what's called your contribution margin or gross profit. From that, you would then subtract out all your indirect or overhead expenses, and you'll see that that's reflected as a single line on this sample. That's just for presentation purposes so that you can actually read the screen. But what would be included there would be the indirect labor. So things like administrative salaries, vacation and PTO, as well as employee benefits, rent, insurances, office supplies, all those types of overhead are going to be included and delineated out under indirect expenses. And that will give you the firm's operating income. This should be a number that reflects the profit that is being generated from performing the core architectural and/or engineering services of the firm. Next, we're going to have other income and expenses, and here's where things like investment type income and expense, gains and losses on the sale of fixed assets, any miscellaneous income that may come into the firm, those things would all be reflected next. And that gives you what I've highlighted here as really the most important from a valuation perspective is the net income before discretionary items. So this is really the income that is generated by the firm that is available to the owners before making what are considered discretionary payments. And I'll use the term discretionary with a little bit of caution. We'll talk about this a little bit here. Because a few of these things you will argue with me are not discretionary, and you will be correct. So for example, discretionary bonuses. There could be contained within the bonuses that are paid in any given year an amount that is customary for a firm that they routinely pay year after year, whether that's holiday bonuses, year-end bonuses, whatever the case may be. And your employees, to a large extent, have come to expect that will be paid, in more or less similar amounts year after year. So whether or not that's discretionary is kind of questionable. In reality, that probably is going to be a recurring operating expense of the firm. Nevertheless, we reflect it in the discretionary category. But when we come to valuing the firm and normalizing the earnings of the firm, we're going to be looking to what portion of that is routine and what portion of that is really discretionary and was driven by the profitability of any given year. Same with profit sharing contributions in general. Those are stipulated by the profit sharing plan. And as with the bonuses, they may become expected to a certain level. The piece that is often discretionary here generally has to do with the owners of the firm who may have a higher matching contribution being made or discretionary portion being paid in. That would be a piece that we would potentially analyze when we start to look at normalizing the firm's earnings stream. Because what we want to do is get to an adjusted earnings stream that really reflects the net income that's available to an owner in the firm, so that if I'm buying into the firm, for example, I'm paying a price that reflects the earnings stream that I'm going to be able to share in once I'm an owner. So this gives us net income before taxes. And then we have a provision for taxes. One of the things that I didn't really mention and probably should have called out here is deferred income taxes. You'll see that they're reflected on this adjusted balance sheet. And if they're not, we will be tax affecting and making an adjustment to put deferred income taxes on the firm's balance sheet strictly for valuation purposes. And when we get to those adjustments, I'll explain why. But that's something to keep in mind, is that we're going to have both the balance sheet and the income statement are going to reflect income taxes. So methods of valuation for a design firm. A proper valuation is both an art and a science, and the science comes from the approaches, the theory, the quantitative analysis that's done with regard to both the subject company and the industry in which it operates. So that really has to do with the facts, the data, and the theory that we're able to apply. The art is represented by those people that have the experience and expertise necessary to apply that science to a given valuation. So it's not as simple as a formula per se. There also has to be a really good understanding of the business being valued and the industry in which you're operating. AE firm valuation, I went through a lot of this, the many different reasons. Internal ownership transition has probably historically been the one that we have focused on and done the most of. However, mergers and acquisitions are becoming much more of a hot topic lately. And that's to be expected, really, just based on demographics, the aging population of business owners, many of whom are baby boomers and are getting ready to retire. So you're going to have more businesses that need to be sold than employees internally in some cases. So a merger or acquisition may make sense. And again, estate gift and income tax is another frequent purpose for valuing an AE firm. So standards of value. There are 3 principal standards of value. And it's basically a set of assumptions regarding the characteristics of the buyer and seller as to whether they are hypothetical or actual. And the overall circumstances surrounding the transaction. So those 3 principal standards of value include fair market value, fair value, and investment value. And we'll talk about all 3 of those. Fair market value is defined in IRS Revenue Ruling 5960 as the price at which property would change hands with a willing buyer and a willing seller. Both parties having reasonable knowledge. And the court decisions frequently add to this definition that hypothetical buyer and seller are assumed to be able as well as willing to trade, and that they're well informed about the property. Fair market value applies in tax situations. It's what's required for estate and gift tax purposes, as well as purchase price allocations and a merger or acquisition. The key elements that I tried to highlight there are the fact that the parties, both seller and purchaser, are hypothetical. The transaction is happening at an arm's length situation, and the buyer and seller are both able and willing. Now, fair market value will consider things like discounts and premiums. So if you are selling a controlling interest, which would be the case often in a merger or acquisition, there may be a premium for control that's required. Similarly, if you're selling just a small minority interest, a discount from full fair market value may be required. And fair market value does contemplate those premiums and discounts. And again, fair market value is not based on a known buyer or seller. They're both hypothetical. So that value could be impacted and would probably no longer be fair market value if the actual buyer or seller's unique motivations were taken into consideration. Fair value is defined statutorily, and it's what comes into play in dissenting shareholder litigation, divorce cases, anything that involves the courts. So it varies from state to state, as well as depending on the legal purpose. Essentially, fair value is fair market value, but without the discounts, generally the discounts for a minority interest or lack of marketability. Some courts will allow the discount for lack of marketability, and that discount means that the shares of stock in your company are not freely tradable the same way shares of Apple are. Therefore, when we arrive at a value, and as you'll see, part of arriving at that value involves looking to the public markets, we're going to have to take a discount to account for the fact that you can't convert a share of stock in your company to cash. It doesn't have the same liquidity or marketability as a publicly traded stock. But generally, fair value can roughly equate to fair market value, but without a discount for minority interest. In other words, you would simply take the value of the whole times the percentage that's being contemplated or valued. There'd be no discount for the fact that that represents a minority interest in the firm. And then investment value is often also referred to as synergistic value, and it's the value to a particular investor based on the individual investment requirements and expectations. So it's most commonly seen in mergers and acquisitions, where there are synergies involved, where there are motivations of the buyer or seller that make the value of an entity more or less attractive, generally more attractive than what fair market value would otherwise just dictate. Levels of value refers to the value of the business considering the characteristics of marketability and minority interest discounts. So what we'll see is you can move between the three standards of value based on the application of some of these discounts or premiums. So what we see here is we start with fair market value, and that value would actually be increased if we move up the levels here. It would be increased by anywhere from 25 to 50%, although I would generally tend to say that 25 to 35% is probably a more realistic range to account for the discount for lack of marketability, or I'm sorry, the minority interest discount. So we're gonna take fair market value and essentially we're gonna put a premium for control on. Or if we were starting with fair value, we would take a discount for lack of marketability to move us down to fair market value. So the difference between those two levels is generally the discount for minority interest discount or control premium being the reverse of that. And then synergistic value at the top, usually there is a premium that is applicable to entities, again, as I mentioned, where you have synergies, where you have perhaps you're looking to acquire whether that's clients, whether that's employees, where we see that quite frequently. You know, obviously attracting and retaining talent is a challenge for many professional service firms, and architecture and engineering firms are no different. So whatever the incentive might be for that merger or acquisition, there's often a synergistic premium that accounts for the difference in value there. And that's, you know, a 10 to 40% premium. I would say that, again, 25 to 30 is probably about right for what we see in practice. Premise of value is an assumption regarding the most likely set of transactional circumstances. So the three main premises of value are going concern value, orderly liquidation, and forced liquidation. And just very quickly, generally, when we're valuing an AE firm, whether that's for internal ownership transition, estate or gift tax purposes, or merger or acquisition, we're going to be looking at going concern value, where the business is expected to operate as it has been going forward into the future. And there are intangible elements of value associated with that, such as your workplace in force, your operational facilities, the infrastructure, processes and procedures, all those things have value. And that's going concern value. Orderly liquidation would be the value if you closed your business, you had adequate time to sell all your assets and collect on all your receivables and obtain the maximum value possible. And then you paid off all the liabilities of the firm. That would give you an orderly liquidation value, as opposed to forced liquidation value, which is kind of the fire sale that you want to avoid because you don't have the time to maximize the receipts for the sale of the firm's assets. Everything has to happen very quickly. And so that's the least value. It's an auction price, if you will. But we're going to be concerned with the going concern value in terms of valuing an AE firm. Elements of value, I won't go into this in too great a detail, just in the interest of time. But revenue ruling 5960 is kind of the Bible, if you will, that valuation analysts need to follow when they're preparing a valuation. And there are 8 factors that need to be considered. I will tell you that we have to consider them all. There are frequently situations where not all of them apply, but we have to at least take a look at them and indicate if they don't apply, you know, why. But certainly the nature of the business and the history of the enterprise, the economic outlook in general and for the specific industry in which the firm is operating, the book value of the stock, which is that equity or net book value that we talked about, the earnings capacity of the business, the dividend paying capacity of the business, whether or not the entity has goodwill or intangible value, sales of the stock that have happened in the past, as well as the size of the block of stock to be sold. Again, is it a controlling interest or minority? And then the market prices of stocks engaged in the same or similar lines of business that are actively traded on the open market. So each of these all need to be considered when we're valuing any kind of entity, and certainly an AE firm. Valuation approaches. There are 3 general approaches to valuing a business: the asset approach, the income approach, and the market approach. Asset approach is based solely on the value of the entity's assets less their liabilities. And that would include both tangible and intangible assets. The income approach is the most widely used method. And that is where the sum of the present values of the expected future economic benefit, whether that's measured as cash flow or earnings, that's attributable to that ownership. The present value of those future earnings stream reflects the value of the firm under the income approach. And then the market approach values a business by referencing entities that are publicly traded or that have sold in the marketplace, and taking the multiples for those companies and applying them to the subject entity to be valued. So looking at the asset approach, the book value method basically just looks at historic net book value or equity. It's your assets minus your liabilities. That's the book value of the firm. If you were employing that method or that method only, that would be the value of the firm. And I do have one or two firms that essentially use book value to transact. I would argue that that is in no way fair market value for a firm, and we'll see why in a minute. Adjusted book value method, what this does is it takes the historic balance sheet and it converts your assets and your liabilities, but predominantly your assets, to their fair market value. And it also looks, are there assets and liabilities that are not currently reflected on your balance sheet? And it would put them on an adjusted balance sheet. And this will give you the value of the tangible and intangible assets and liabilities of the firm on an adjusted basis. But again, this represents liquidation value as opposed to a true fair market value for your AE firm. For the asset approach, and specifically the adjusted book value method, due to the fact that a lot of the amounts reflected on your balance sheet are based on historic cost, that may or may not accurately reflect the true fair market value of the assets and the liabilities as presented on your balance sheet. So some of the common adjustments, just to give you a flavor for some of the things that we would look at. If the firm has securities and investments listed, you may have a brokerage account. We would look to make sure that those have been brought to their current fair market value as of the balance sheet date, or mark to market. Build receivables and an allowance for uncollectible AR. In some cases, firms track their accounts receivable separately from their accounting software that's creating this balance sheet, and it may not reflect the receivables. More often, it's that an allowance for potentially uncollectible accounts receivable may not be reflected. And that's something that we would want to look at. The reason being, if I'm buying, let's say, a 5% interest in your firm, and a portion of that is premised on the adjusted equity of the firm, I'm essentially paying for 5% of the receivables, and we would want that to reflect the true value of the receivables that are likely to be collected. So if there are amounts on there that are questionable, we would want to reserve for those for valuation purposes. Unbilled work in process is a big one. Depending on the type of software that you use, some firms do not reflect their unbilled work in process, which essentially is your the work that you have done, the time and expenses that have been incurred on a project that have yet to be converted to receivables. So typically that can be, as a rough guesstimate, is going to be based on your annual fees divided by basically your billing cycle. So if you bill once a month, you probably have 1 month's worth of fees sitting in unbilled work in process. The norm for the industry is more like 14 to 15 days, because most firms bill twice a month. But that's definitely an asset of the firm that we would want to bring onto the adjusted balance sheet for valuation purposes. And again, we would consider whether there were any amounts reflected in your unbilled work in process that might not actually be billed, and we'd create an allowance for that. Property, plant, and equipment. So consider the balance sheet that is reflected on the cash basis or the tax basis, where perhaps you're reflecting depreciation utilizing your tax basis depreciation as opposed to book depreciation. So at the end of the year, we purchased $20,000 worth of software or computer equipment, and we immediately expense that under section 179. So we depreciate the full 20,000 on your internal balance sheet that now has a fair market value or an adjusted book value, I should say, of 0, which is not at all reflective of the true value of an asset you just acquired. So what we do in those cases is we look at instances where accelerated depreciation has occurred. We reverse that and then depreciate it over the expected useful life of those assets. And that will give us something more realistic in terms of fair market value. If there is extensive equipment that needs to be valued, that may require having an appraisal done by an outside party. But generally, we find that just taking a look at accelerated depreciation and then looking also at assets that may be fully depreciated, that you've had for many, many years, but are still in service, we would want to give some value to that because certainly it's worth something and it's contributing something to the operations of the firm. Real estate, if any, there are a handful of ways to address this. You can have an appraisal done. Again, that's not done by Dannible and McKee. You'd need a real estate appraiser. Other times firms will just accept that book value is fine, or they may agree on a number internally. And that's frequently the case where you're doing this for internal ownership transition, is you have a feel for what the real estate is worth, and everyone agrees, and that's just stipulated in the agreement. Libraries, maps, and drawings. Think of this as your technical resource library. It's basically the some of the systems, templates that you have in place that you don't have to recreate every time you go to do a project. And we would look at what would the cost be to recreate those things, whether through purchase or through the use of some of your staff's time, and we assign a value. If you had a joint venture, that may need to may or may not need to have a separate valuation to see if that's needs to be brought to its current fair market value. Cash surrender value of life insurance, many times that's not reflected on your balance sheet, but it should be, at least for valuation purposes. And then unrecorded liabilities. Sometimes there are liabilities of the firm that don't make it to the balance sheet. And a big one is vacation and sick pay. So this is a liability in the event that someone leaves and is required to be paid out. So that's something that we need to take a look at and put on your adjusted balance sheet. Deferred compensation also, if there are prior existing deferred compensation liabilities, that needs to be reflected on the balance sheet. And then deferred income taxes. So I had mentioned previously that we need to look at deferred income taxes. Basically, we need to account for the fact that the collection of your receivables, just keeping it simple and just looking at the collection of receivables, is going to require the payment of tax. And even if your firm is a pass-through entity that doesn't pay tax in and of itself, the cash to make those estimated tax payments at the individual level all comes from the firm. So we essentially need to make an allowance for the fact that that needs to get paid out of the proceeds and reduce the value. So if the receivables were the only asset in the firm, we would want to reduce that value by the income taxes associated with it, so that when I buy my 5%, I don't pay for the full value and then pay the tax on top of it. I would only want to pay you what it is worth to you as the seller, which would be your 5% of the AR less the taxes that you would pay out. That's what it's worth to you as a seller. That's what I should pay as a purchaser. And calculating deferred income taxes using, if you're a C corporation, then we would use the appropriate corporate rate. If it's a pass-through entity, we would use the effective income tax rate of the higher earning shareholders. Pros and cons. Asset approach is easy to calculate and understand. It establishes a baseline value. Cons, it ignores the future earnings capacity of the business. So as you can see here, you have two firms with the same book value, but one has twice the after-tax earnings. Are both firms worth the same? Obviously not. And I need to speed up my pace here a little bit, I think. So income approach is the most forward-looking. It's concerned with the future expected economic benefit stream, whether that's earnings or cash flow. And it can be represented by a fraction that takes the expected future economic benefit stream and divides it by a discount rate. But let's see, it's one important thing to point out here. It's the number one mistake that uninformed valuation professionals make is to not match the economic benefit stream with the discount rate. Pre-tax, after-tax, all of those types of things need to match up. We would typically use after-tax net income. The reason is because the discount rate is going to come from the public markets, as we'll see in just a second. And therefore we need to match that discount rate. So because those rates of return are coming from the public market, and the public market is tax paying, those are after-tax discount rates. Typically we use past earnings as a guide in instances where firms don't have future earnings projections, and it is quite rare for most small businesses to have the level of projected earnings out that we would need to do an analysis like this. So typically, we're going to be looking at the last 5 years of historic income statements and normalizing those for items that that may be unusual, non-recurring, non-operating, or where the accounting method fails to reflect economic value, like depreciation, as I mentioned before, where tax depreciation is not reflecting economic depreciation. So just quickly, I'll touch on a couple of these. Discretionary bonuses and salaries. So to the extent that they truly are discretionary, we would want to add that back to what's being valued, because that's what the seller's giving up and the purchaser's acquiring, is the right to share in that pre-discretionary earnings flow. The same with the pensions and profit sharing contributions that we talked about. Depreciation, again, we would want to we'd want to normalize that, adding back all that accelerated depreciation and taking it on a straight line basis over the useful life of the assets. Non-recurring expenses, so you might do an office move or open a new office. You may have an E&O claim that is a one-off. Any of those types of non-recurring items, we would want to add those back so that we get a more normalized earning stream to value. Rent and any other related party charges. So in the event that the building that a firm is operating out of is owned by the same parties that own the firm, sometimes the rent that's being paid or not paid isn't commensurate with a true arm's length fair market rental. So we would want to look at that and make sure that that we were on the right on the right basis, and that we've normalized what that should look like. And it's not driven by year to year cash flow and tax considerations. And then non-operating items, gains and losses on the sale of fixed assets, investment gains, et cetera. And as I mentioned, we're going to tax affect the earnings just like we did the balance sheet. And I talked about the effective tax rate that we would use. Again, we would look to historic earnings, normalize those. The look back period that is generally the best to use for an AE firm is 5 years because it encompasses a full business cycle. Anything longer than that doesn't generally produce much more value, and anything shorter than that can be dramatically impacted by a year or two where something abnormal is going on. Think COVID for one. Just looking at a 2 or 3 year period would be dramatically impacted by something like that. Not that we wouldn't adjust for what had happened with COVID, but certainly a 5 year period tends to smooth out all of those ups and downs and capture a complete business cycle. Now, the averaging convention, when we look at those last 5 years that we've normalized for all of the non-recurring and unusual items, if we just did a simple average, you would see that firm A and firm B both have average earnings of 20,000, but that's misleading because firm A's annual after-tax net income is increasing while firm B's is declining. So the trends here make a difference. As you can see here, where a trend is present, weighting each year with the higher weighting going to the most recent year will capture the trend inherent in the earnings stream that we're looking at here. And we would end up instead for firm A with an weighted average value of 25,667, whereas firm B that was in decline would have a weighted average earnings of 14,333. So typically when we don't see a trend, a simple average tends to make sense. But if there is a trend happening, using the weighted average makes a lot of sense. Now, the earnings stream was the numerator of our income valuation approach. The denominator is the discount rate, which really reflects the rate of return that an investor requires in order to be attracted to an investment. So what is the rate of return that someone requires to invest in your firm? And I'm going to speed up through a little bit of this. We're going to use the build-up method. And essentially what we do is start with what is as close to a risk-free rate as you can get, which is approximately the 3.5% that you can get on a 20-year treasury bond or its equivalent. And then to that, we add different premiums that reflect the increasing layers of risk. So because we're talking about a stock and not a treasury bond, we're going to add 5.5%, which is what the market has observed over decades as being the additional rate of return that an investor requires to invest in stock as opposed to a bond. Then we're going to add a size premium just to reflect the fact that that we're talking about very small firms relative to the overall stock market, and that's another 10.73%. And these numbers don't fluctuate a ton year over year. Next, there's a premium for your specific industry, which is about 1% for the AE industry, and that reflects the additional rate of return that investors in this industry require as opposed to the S&P or the market overall. And then finally, subjective risk premium. This is going to take into account the specifics of your company, management strength, diversification of services, geographic area, all of those, your balance sheet strength. We're going to analyze your company's ratios to see how you compare to your peers in terms of earnings, in terms of risk, all of those things. That's going to give us a subjective risk premium. The total of these is the discount rate. A discount rate is applied to future earnings stream, to a series of future earnings streams or cash flows. But in instances where we're gonna apply it to a single number, which would be the case when we're averaging historic earnings, we're gonna actually use a capitalization rate. And to get to that, we just remove the long-term sustainable growth rate that's expected. 3% is about what we've seen in the industry. That's pretty reasonable. And again, that's long-term sustainable. So that's into perpetuity, hypothetically speaking. It's not the 10% that you project next year or the 5% you think it'll be each year for the next 6 years. It's what's going to be the long-term sustainable growth rate into perpetuity. That would give us a capitalization rate of about 25%. Converting that to an earnings multiplier would make that a 4. So 1 divided by 25% would be the multiplier of earnings. This will go through the different things that we would look at in the subjective risk premium. Income approach pros considers future earnings. It measures value in terms of a benefit stream, which is what you're concerned with as an investor, whether that's net income, EBITDA, cash flow. The cons, it's difficult to establish future projections that are reliable. So as I mentioned, a lot of times we're looking at historic earnings and then normalizing those. And there is the subjective piece in the discount rate. It is also the most complex of the 3 methods. Considering this, now we have 2 firms with the same after-tax earnings, but a very different balance sheet and equity. Are those 2 firms worth the same? Again, no. So this should be giving you a hint as to where we're going with the approach for valuing an AE firm. For the market approach, all I'm going to mention on this is that we're essentially looking to the market, whether it's publicly traded companies or completed transactions of non-publicly traded entities, or rules of thumb. All of those are looking to the market to value your firm by applying those multipliers to your metrics. The problem with that is, number one, it's very difficult to achieve comparability. Publicly traded AE firms are generally conglomerates that are not just engineering, for example. And secondarily, the industry rules of thumb are averages, so they certainly don't capture the nuances of your particular firm. So with that being said, we utilize this approach as a sanity check in looking at the value that we otherwise come to, just to make sure that we're in the right range. But this is not a method that we would generally afford any great weighting, if any, in valuing an AE firm. Rules of thumb. So how do we value a professional design firm? Well, we've looked at the fact that there's value on the balance sheet of the firm. And we discussed that that was essentially the orderly liquidation value of the firm. In other words, if you as a shareholder, as a seller of your firm, were to cease operations, close the doors, collect your receivables, sell your assets for the highest price you could get, and then pay off all of the firm's debt, that would leave you with an adjusted net book value that would be the liquidation value you could walk away with. So that's a floor or a minimum value for the firm. But above and beyond that, there's an asset that's not reflected on your balance sheet, and that's the goodwill value of the firm. That reflects the fact that you're not closing the doors, that you have a history, that you have a reputation, a client base, employees in place, infrastructure. All of these things give goodwill value or practice value to the firm. And we need to value that essentially and add it to the adjusted book value of the firm from your balance sheet. We've coined this, the AE formula approach. If you were to look in a valuation handbook, you certainly would not see this as a method. It's something that we've come up with, but we've been doing it for 40, almost 45 years in the AE field. So we're pretty confident in calling this the AE formula approach. We're fair market value for a firm is equal to its adjusted book value plus its goodwill value. And that goodwill value is determined using an income approach like the capitalization of earnings. I'm gonna skip this. So this is reflecting some of the valuation adjustments that we would make to the balance sheet. As you can see, there is an allowance for doubtful accounts for the firm, but we're making an adjustment to increase that based on presumably discussions with management. They may have some specific receivables that they know are unlikely to be collected, or we may be looking at the firm's trend in bad debt over the years and taking that as a percentage of accounts receivable to come up with a more realistic estimate of what that allowance should be. One of the things I'll mention here is that, excuse me, these adjustments that we're making, we're not making them to your actual books and records, so don't get nervous. This is something that we're doing outside on a kind of a standalone basis just to come up with the firm's fair market value. So we're not asking your bookkeeper to go back and make adjustments to your books. These are things that we're doing just to determine fair market value. Another caveat would be that if you have reviewed financial statements or audited financial statements for any reason, some of these adjustments probably wouldn't even be necessary because a lot of them would already be taken into account. You would have the correct allowance for doubtful accounts already on there, and your unbilled work in process would be recorded, for example. That's the second adjustment. That's a very common adjustment, is to have to bring on what is the amount that you could bill if you were to pull the trigger, so to speak, on your billing cycle at the valuation date. Under accumulated depreciation, this is where we generally have an increase to the net book value of your fixed assets to account for the fact that you may have taken accelerated depreciation, and you may have fully depreciated fixed assets that we need to look at. Libraries, maps, and drawings, we usually come up with an agreed upon amount with management. Joint venture, that may need to be increased to its fair market value versus the initial investment. Accrued liabilities, probably like an unpaid PTO liability is a common one. And then the deferred income tax calculation to bring on that liability would result in an adjustment to your stockholders' equity from the historic to the adjusted. This one's very small in net. It's usually a little more meaningful than that adjustment. That's just how this particular example worked out. And then again, we would look at the 5 years historic income statement. We would start with pre-tax net income off of those financial statements, and then we would make adjustments to pick up things like the change in work in process, like adjustments to officers' compensation or discretionary bonuses, non-recurring expenses, like maybe the computer software that you see number 7 there, to add it back and then spread it out over the useful life, things like that. And then that's going to give us our pre-tax adjusted net income. We will tax affect that to get our after-tax adjusted net income. And then we're going to use the proper averaging convention. In this case, we're using a weighting, which would give us average net earnings on a weighted basis of about 219,000. We're going to multiply that by our earnings multiplier of 4, which, if you recall, is the inverse of the capitalization rate of 25%. So that multiplier gives us a practice value or goodwill value of 875,000. That goodwill value would get added to the adjusted book value that we came up with of 1.6 million. And we end up with a total value for the firm of 2.5 million under the AE formula approach. That was a lot. One of the questions that I see, we have numerous questions here that I won't obviously be able to get to, but any questions that you put up there, or if you want to email me, that's fine as well with anything that comes to you afterwards. We'll definitely get back to you, but one frequent question is, was this being recorded? The answer is yes, and a copy of that will be sent out to each of you. I wanted to mention as well that we have some more upcoming webinars, so keep an eye out in your email, and certainly you can go to our website, dmcpas.com. These are the ones specifically for the AE industry. As I mentioned, it's an industry that we certainly specialize in addition to my work in the valuation and ownership transition arena. I was, until this past year, for the last 20 years, a tax partner, and the majority by far of my clients were AE firms. So we make a real effort here at Dannible McKee to specialize in industries, and this is one that we have a lot of expertise in. So I hope you'll join us for some of these upcoming webinars. As I said, there isn't a ton of time for questions, but I will certainly respond to any that you throw up there. And alternatively, you can check our website and get my email and reach out. And I thank everybody for attending today.